Hey, Andy, have we seen the worst of the Archegos hit here? Like, is this it?
I hope we've certainly seen the worst of it. I think Credit Suisse was definitely going to be the worst of it. We've still got a little bit to go, according to both Credit Suisse and UBS, about seeing just the last tail of those losses to come through partly in the second quarter, but most of those positions are all through now. But the really big bit that needs to come next is why did this happen? How did this happen, and how can they stop it happening again?
My colleague Elisa Martinuzzi, I thought it put it beautifully in a piece that she wrote for Bloomberg Opinion, Andy, a little bit earlier on. Clients need to be asking themselves the question, how did a single client event end up doing more damage than the pandemic? How are we in this situation?
I wish I could answer that question. I'm sure a lot of the people involved in making all the rules after the financial crisis are going to be asking the same questions. I mean, it's very odd, for banks to take a loss on some collateral they collect when there's a margin call isn't super unusual. But for stocks which effectively, a lot of these stocks are flat year to date, they're not even down that much year to date. So we've taken such a huge amount of leverage and then not be collecting on the margin in a systematic way is certainly worrying. Whether it's because they were a family office and not a prime client might be a reason, but it's kind of up to the banks themselves. I'm not sure I'd agree that we need regulation. I think the culture of the way the regulators have pushed culture and risk management should have been able to capture these things already. It's whether those risk management functions have been overridden in the past, which is I suspect what the regulators and the supervisors are going to be looking into, how that risk management function operated, whether it was flagged and then overridden, which would obviously be a cause for concern.
So, Andy, UBS, for example, looking for more transparency from their family offices and other big clients at the wealth management division. They're not going to close their prime brokerage unit or anything or pare that down like Credit Suisse. And I guess my question is, will the aftermath of this affect the way that they're able to do business? I mean, you do need banks to take on some risk. So is there going to be kind of a learning curve?
Absolutely. No, we want banks to take risk. We certainly don't want them to be any more risk averse than they are on normal bits of business that they do, because the economy needs banks to be able to take on risk for economies to grow. What happened here, though, seems to be, I would hope it would be an outlier. For the European banks in particular, we have to ask why they were taking such large risks relative to the size of the overall bank. And if you look at the trouble that the European investment banks have had for many years now, it's been that they've really struggled to match the profitability of the larger scale players in the US. And it really begs the question that if you have got one of those smaller scale investment banks, they're still large businesses, but they're nevertheless much smaller than their US cousins. If they're smaller, they haven't really got those diversification benefits. And so can you operate these smaller investment banks where you're always stretching to reach these ROE targets, and then what appears to be taking on some extra risk?
What are you expecting for the rest of the week? Got a lot of banks coming out with numbers over the next few days. Those smaller investment banks you referred to, have they been able to keep pace this quarter with what's happening in the States?
I think, without the Archegos losses from Credit Suisse and UBS, actually the results would have been very, very strong. So the underlying businesses had actually been doing very well. We've got Deutsche coming up. We'd expect to see some strength there. Management had already guided for IB revenues to be up 20%, although judging from what the US peer group have done, there could be some upside surprise to that, we think. So I think the overall, the day-to-day business that they've been doing in the past quarter is good. There's some question marks about how sustainable that is into the rest of the year. I think that's true of the US and of the Europeans. So outside of the Archegos losses, actually things should have been pretty strong in the first quarter.
I just want to get your take overall on sort of the talent shift. And you can see this with HSBC, for example, hiring a lot of people, which is raising the kind of compensation ratio that they have. As an analyst, do you like that? Like, do you want to see all these banks hiring a lot of people, even if as they compete for talent or not? How do you look at it?
I think it depends in what areas. We don't want the banks to book a load of revenues and then hire a bunch of people after after they've been busy. That's certainly not what we want to see. Most of the hiring that HSBC was pointing to today was actually in the wealth management business. So that's a business which you'd expect to be on a sustainable basis, earning above its cost of equity, because it's a very capital-light business division that the banks operate in. So that aspect of things we really like. Hiring more people into investment banking, it depends what roles they're in, but we're certainly looking for much more efficiency. The European investment banking businesses aren't the most efficient in the world, and they're not yet consistently hitting their cost of equity. So we don't want to see them adding too many more costs on too many more salaries if the revenues aren't going to follow through.
Andy, can I just ask you a question about footprint and travel? HSBC is talking about cutting its footprint. I think the long-term target is 40% in terms of the office space. Short-term target 20%, but also talking today about absolutely slashing corporate travel. Scott Kirby over at United Air is on a call right now talking about the fact that he sees business travel likely to return in January. What is the potential, the long-term potential for banks to reduce costs as a result of the pandemic?
I'm not as convinced that would be such a large cost driver. I think it's quite a good thing for their own ESG targets to reduce their own carbon footprints. It will help costs a little bit. I wouldn't have said it was so material in 2020 when there was almost no business travel. I am interested from the ESG, reducing their carbon footprint, but really for the banks, they really need to look at the carbon footprint of their lending portfolios. That's really where they can make the biggest difference. The bank's own emissions are really almost insignificant versus the emissions coming from their lending portfolios.